Investing in the stock market can be a profitable endeavor, but it can also be a daunting and risky one. To navigate the complex world of stocks successfully, it's crucial to understand the what and why of stock market investments. What is stock market? Investing in the stock market is a way to participate in the ownership of companies and potentially grow your wealth over time. When you buy shares of a company's stock, you become a shareholder and have the opportunity to benefit from the company's success in the form of capital gains and dividends. However, it's important to understand that stock market investments come with risks, including the potential for losses if stock prices decline. Successful investing requires research, a long-term perspective, and a diversified portfolio to manage these risks effectively. The stock market can be a valuable tool for achieving financial goals, but it's essential to approach it with knowledge and a well-thought-out strategy. Each share represents a fractional ownership stake in the company. Here's how it works. First is ownership stake. When you buy shares of a company's stock, you are essentially buying a piece of ownership in that company. The more shares you own, the larger your ownership stake in the company. Second one, voting rights. Depending on the type of stock you own, common or preferred, you may have the right to vote on certain company decisions, such as the election of the board of directors and other significant corporate matters. Common shareholders typically have voting rights, while preferred shareholders often do not. Third, dividends. Many companies distribute a portion of their profits to shareholders in the form of dividends. The amount of dividends you receive is typically proportional to the number of shares you own. Preferred shareholders often have a fixed dividend rate, while common shareholders receive dividends based on the company's profitability and the decisions of the board of directors. Fourth, capital gains. As the company's value and profitability grow, the price of its stock tends to increase. When you sell your shares at a higher price than you paid for them, you realize a capital gain, which represents the increase in the value of your ownership stake. Fifth, risk and liability. While owning stock gives you a share of the company's profits and assets, it also means you bear a portion of its risks. However, your liability is typically limited to the amount you invested in the stock. You are not personally responsible for the company's debts or legal obligations. Stock exchanges like NYSE and NASDAQ. The New York Stock Exchange, NYSE, and the NASDAQ are leading stock exchanges, each with its distinct characteristics. The NYSE, established in 1792, is one of the world's oldest and largest stock markets, known for its iconic trading floor and its focus on established, often blue-chip companies. It employs a centralized auction model, and its specialists facilitate trading. On the other hand, NASDAQ, founded in 1971, is renowned for its technology-driven, electronic trading platform, making it a go-to exchange for tech-related and growth companies. NASDAQ operates with a dealer market model, using market makers to facilitate trades. Both exchanges provide opportunities for companies to raise capital by issuing stocks and offer investors a platform to buy and sell securities, contributing significantly to the global financial ecosystem. Understanding the differences between these exchanges is essential when considering where to list a company or invest in stocks. Why invest in stock market? Capital appreciation in the stock market refers to the increase in the value of your investment over time, resulting in a profit when you sell your stocks at a higher price than what you initially paid. This potential for growth exists because companies can become more profitable, innovate, and adapt to market changes, driving their stock prices higher. However, it's important to recognize that the stock market carries risks, including volatility and the possibility of losses. To maximize the potential for capital appreciation, investors often adopt a long-term perspective, diversify their portfolios, and stay informed about economic and market trends. Stocks play a crucial role in long-term wealth building due to their potential for capital appreciation and the power of compounding returns. Here are some key roles that stocks fulfill in long-term wealth building. First, capital appreciation. Stocks have historically shown the ability to grow in value over time. As companies become more profitable and expand, their stock prices tend to rise, allowing investors to benefit from capital appreciation. This growth potential can lead to substantial gains over the long term. Second, dividend income. Many stocks pay dividends, which are regular payments to shareholders from a company's profits. These dividends can provide a consistent stream of income, especially when reinvested, further enhancing the potential for wealth accumulation. Third, diversification.
Stocks offer a wide range of investment opportunities across various industries and sectors. Diversifying a stock portfolio can spread risk and reduce the impact of poor-performing assets, contributing to more stable and sustainable long-term growth.
4. Inflation hedge. Stocks historically have the potential to outpace inflation. As the cost of living rises over time, investments that can generate returns exceeding inflation are crucial for maintaining and growing wealth. Ownership in profitable companies. Owning stocks means owning a piece of a company. This ownership comes with a share in the company's profits and assets, allowing investors to participate in the success and growth of businesses. Compound returns. The power of compound returns is a key factor in long-term wealth building with stocks. When you reinvest dividends and allow your investments to grow over many years or even decades, your initial investment can multiply significantly. 5. Flexibility. Stocks offer flexibility in terms of investment horizon. Whether you're investing for retirement, a major purchase, or generational wealth transfer, stocks can be tailored to meet different long-term financial goals. 6. Tax advantages. In many countries, there are tax advantages associated with long-term stock investments. Capital gains and qualified dividends may receive favorable tax treatment, allowing investors to keep more of their returns. 7. Dividends. Dividends are regular payments made by some publicly traded companies to their shareholders as a distribution of a portion of the company's earnings. Last, passive income. Passive income refers to earnings that require minimal active involvement or ongoing effort from the recipient. In the context of the stock market, passive income can include various sources of income, with dividends being one of the most common. I hope you gain a lot of knowledge about stock market investments. Please like, share, and subscribe to our channel. See you in the next video.